Hi, and welcome to the Fund Selectors podcast with me, your host, Lucy Walker. I am a huge supporter of the voice of the fund buyer, and this podcast dives deep into the minds of the biggest and best in our industry. Today, I'm delighted to be joined by Ben Conway, CIO and Head of Fund Management at Hawksmoor, based in Exeter. Ben runs a range of fund of funds, along with 3 colleagues, with assets totalling 1.3 billion. And those fund of funds are the team's only focus. That comes across in spades in the conversation, with the focus and attention that Ben and his colleagues are able to put on fund research and fund management. One of the most interesting parts of the conversation was the discussion around what they look for in a fund, and one of the biggest things is a fund's relative performance, but not relative to an index or to a sector, but relative to the fund's own history. Is the portfolio cheap relative to history is the question that gets Ben and his team excited about funds. The conversation spanned many topics, and we finished on investment trusts, which play not only a big part in the Hawksmoor Fund of Funds, but also Ben has been a significant part of the cost disclosure campaign. And so we touched on that at the end. Interesting, I think, both whether you're well across the issues around cost disclosure or it's a new topic. It's a really significant issue for the industry. It was a great conversation, and I hope you enjoy it as much as I did. Hi, Ben. Welcome to the Fund Selectors podcast.
Hi, Lucy. Thanks for having me.
My pleasure. Looking forward to this conversation. The most time I've probably spent with you in recent times is the active passive debate that we did actually a little while ago now, but one that I knew would spark a really interesting conversation. Can we start with just how you and your colleagues at Hawksmoor are going about fund research, because you are obviously very, very focused on the fund of fund range that you run. And I just think it gives you a bit of freedom to look at funds in a way that perhaps other people in the industry maybe have kind of more shackles, whether that's, their colleagues in private clients or whatever. So yeah, just really wanted to start there, if that's okay.
Yeah, sure. So we, as you say, got complete freedom. And we are not, what's the word I'm going to use, slightly emotively, we're not sort of restricted by any really regimented firm-wide protocols or processes. So, for example, what that means we don't like sending off a DDQ to somebody to fill in. And, it's not like there's a DDQ that must be filled in. We don't have any requirements when it comes to track record or size or anything like that. Our research is really very, very bespoke. It can be quite involved, very, very reliant on interviewing the fund manager. So that means the flip side of that is that, yes, we do the quant work, and we do, check what the fund manager might be saying against results. And yes, we will look at a track record, but it really doesn't form a major part of the process. So it's very much based on asking questions, very, very bottom up, and going where we think we need to go in terms of the questions that we're asking. So, there's not like a set number of questions that we go through every time we meet somebody. And the other thing is as well is that when the way we even construct portfolios is, I think, very, very different. So again, what we don't do any strategic asset allocation or tactical asset allocation. Don't necessarily think that produces best client outcomes. And when we're researching somebody, it may not even interest us about their performance versus either a performance comparator or a benchmark. So we're not doing like, okay, we've identified value in European equities. Let's go and find a European equity fund manager. It may be that what we actually like about the fund and the fund's portfolio is the role it's performing in our portfolio and the attributes that portfolio has that brings to us, and whether it performs or doesn't perform versus its chosen benchmark or the pool in which that fund manager happens to be fishing in, that might be quite irrelevant to us.
Okay, a lot there to dig into. So let's just go in reverse order. So let's start with what might be the scenario where you are looking at a manager who is, as you say, kind of fishing in that pool and would typically be compared. What might be a scenario where you are actually thinking about them in quite different terms? Can you perhaps give us, a specific example just to help illustrate?
Yeah, sure. So the key, okay, let me answer that in a slightly different way. The key attribute we look for in every single thing we buy is the portfolio, and I will say portfolio versus rather than asset, because the portfolios are ever changing. So it's not a static allocation to an asset class necessarily, but we're looking for the fact that that portfolio is cheap relative to its own history. That's kind of like the number one rule. And so when you've got a portfolio of ever-changing equities, it's not just that portfolio of equities, those equities are cheap relative to their own history. It's the process. Is the manager's process, and when they look at the portfolio metrics, say for example through time, recognizing that the actual portfolio is changing, are those metrics clearly demonstrating cheapness relative to history? That's because we're always looking for a margin of safety. And that's really important because we know our portfolios are always diversified, because we know we're going to get something wrong. We don't have a macro view. We don't sort of start with the premise of, right, we've formulated this macro view and we think that the market's really underestimating what inflation is going to be, and therefore we're going to put 25% of the portfolio in index-linked bonds because we think real yields have been misestimated by market participants, and we're going to take a view on that. It's the exact opposite. Like, we don't know what's going to happen, so let's just concentrate on getting the things that we're picking correct. So at the same time, we recognize that at any one time that we're not going to be getting something necessarily right. So while the thing that we're not getting right, while that thing isn't working very well, while that portfolio isn't working very well, we need the downside to be limited. And if the downside needs to be limited, you need a margin of safety. And the best estimation of a margin of safety is cheapness relative to history. And so, okay, bringing that all together, if you've then got a portfolio where everything has that characteristic, and if everything in the portfolio is somewhat uncorrelated with each other, I say somewhat because usually nothing's, you never can achieve perfect diversification, then the whole portfolio will possess, in the jargon, this lovely convexity, which is that generally speaking, it's going to, through a market cycle, it's going to perform really, really well, because it's going to have limited downside but commensurately more upside. And then at the individual asset level, the stuff that isn't working is going to be performing less badly than the things that are performing well are performing well, if that makes sense, in eloquently. So let's take it to a live example. It may be that we think US equities are in aggregate, so these are a really obvious example, are really expensive. And we may identify a portfolio of equities that are US and they're really cheap relative to their own history. And they're bringing something really different to the portfolio, but it turns out they underperform massively the US index. We're just like, well, so what? If the reason for why it's underperforming the US overall index are justified and are expected, then that's absolutely fine for us. Does that make sense? Long answer.
It was a long answer, but it was a useful answer because it's illustrated a lot about the way that you guys think. And I guess one immediate thought is how, when you are building portfolios, obviously you've got different factors affecting cheapness in different markets. So yeah, there'll be that kind of element of diversification. But I would imagine that the past decade, there has been more correlation rather of those strategies than there has been previously. You can tell me if that's an incorrect assumption. So I'm just interested, does that tend to mean that you own kind of no growth, or how does that work from a kind of like stylistic perspective?
Yeah, lots of people often understandably just leap. I'm not saying that's what you've just done, but leap to the conclusion that we're value investors, and we're not. We're valuation investors. And so, for example, when it comes to growth, growth is always going to be, as a style, as a factor for looking at metric for metric, is going to be more expensively valued than non-growth stuff is. But what we're really looking at is the relative valuation history. So if the premium of growth stocks is very narrow versus non-growth stocks, then that's brilliant. That means it's growth as a factor is cheap relative to its own history. So we have historically had lots in growth, But you're absolutely right. More recently, we've had less in growth. But actually, at the risk of going off on a tangent, that isn't actually a really accurate characterization of markets right now, growth versus value. I'm not saying that you just have and keep building straw men and like answering the questions that I want to answer. Sorry. but growth versus value isn't that useful a distinction at the moment, or dichotomy. What we observe is there's huge amounts of valuation dispersion, which means basically really, really big cap stuff and really liquid stuff is the most expensive stuff. And then under the surface, there's loads of cheap stuff. And the cheap stuff, there's some really interesting growth stuff in there and really interesting, cyclical stuff. There's a mix. So if you take a little bit of market cap risk, so going down the market cap spectrum, you can identify portfolio managers, apart from that little bit of market cap risk, that aren't really taking any massive bets towards cyclical sectors or growth or whatever. And that's really exciting.
Nice. Yeah, no, that makes complete sense. I remember looking on LinkedIn recently and seeing I think Stephen Holden did a graphical representation of NVIDIA weightings, and basically kind of illustrating, it was really making the point that obviously we've just very recently seen NVIDIA, have the DeepSeek rotation or initial kind of reaction. And as a result, it was showing that basically everyone was underweight. Clearly, the value managers were the most underweight. Core managers were still pretty underweight, but actually even growth and high growth managers were on average 1% underweight of a whatever 4% position. So obviously on aggregate they were still hugely exposed to NVIDIA. But yeah, it's a really an interesting point that obviously there's a huge swathe of growth managers out there that are going like, we see those stocks, but actually we don't need those to get the growth characteristics into the portfolio that we like. So yeah, that makes a lot of sense.
Yeah.
Cool. So I wanted to go back to something you said right at the beginning or early on in your answer, in relation to how you go about manager meetings and interactions. So you talked about how you don't have, because actually you kind of answered the question that I initially had, which was like, well, how, what are your questions? Because you said that you kind of go in and you have, and then you said, well, we don't have any set questions. And actually, it very much depends. And so I wondered if we can just dig into that a bit more. Would love to hear, how, because there's loads of different ways of doing fund research, but kind of largely it follows a similar sort of pattern. You get some sort of sense of the manager up front, you do a meeting, you do that kind of quant checking that you mentioned. But yeah, I would love to just really dig into that bit where you're kind of using that interview to just get under the skin and really know what you're dealing with.
Yeah, the key question is, why should I invest in your portfolio now? So I know what I'm meant to say is probably, let's understand the process and go and skim the process and then do all that and then make a judgment about whether we should. What we'd much rather start with is, okay, what our job is we see our job is via our funds to, at the very, very least, give our investors a positive real return after taxes and charges. That's like our minimum objective. We don't like, we want to outperform the sector. We don't know. Hopefully that will happen. But what we're trying to do is meet our investors' true objective, which is the growth of their purchasing power through time in real terms. So when we're meeting, every single thing we add to our fund has to be performing a role. I said it has to, bring some element of diversification, have its own margin of safety, but also it has to contribute to that objective. So if it's not going to do that, that's going to really impact our decision on whether to invest with the manager. So we start off by saying, how do you feel about your portfolio today? Are you excited? And you'll find that you'll know this, but the very, very best fund managers, you build a relationship with them through time, and they get to know you as an investor, and they know what you want, the sort of questions that you're going to be asking them, and they will say that, the portfolio isn't that cheap relative to history, but I think it's going to generate these sorts of returns for these reasons. It's going to come from these areas, and again, the best managers will be saying, I know I've had or they'll ring you up, or their colleague will ring you up, and they'll say, I think you guys will be really interested in us now. Yeah, we've had an absolutely shocking past 5 years. The numbers all look terrible, but we now think that the portfolio is trading at the 99th percentile of valuation, relative to history. These have got all the attributes that you want. So a lot of the time, because we've been around for a long time, a lot of it, we got that sort of natural filter of people knowing what we want. But going back to your questions, what we really want to know is ask the questions that get us to the point of, is this portfolio or fund going to contribute to us? And at the very minimum, that is, okay, how do you feel about the portfolio? How excited are you about this portfolio today relative to history? And we are very alert to the marketing stuff. As soon as we start hearing, because we hate relative, don't want to hear the relative story. Our investors don't eat relative. They eat the number on the page. They eat the absolute performance. And that's how we think as well. So we're very alert to a manager who is I would call that quite commercial. But at the same time, I want to express some sympathy with that. And I don't want to criticize too harshly, because the way that most of our world works is back to this SAA framework. Right, here's our US equity block. And you might have a US equity analyst, and the US equities analyst is tasked with, I've got this 40% or 50% or 75% allocation to US equities that my managers will work with. And I've got to find the funds that I think are going to outperform. And so you're already living in this relative world, and that's how a lot of the industry thinks.
Yeah, totally. You're definitely less common for having that kind of absolute mindset, and it's not a surprise to hear many managers think in absolute terms. I always remember, can probably remember on one hand in my whole kind of fund research career the number of managers that said, to be honest, don't buy our fund now, or or this is the worst value it's ever been, or something to that effect. And the salesperson is kind of next to them, like going, oh god, don't say that. But actually, the truth is, those are the managers. To your point about it's a relationship and it's something that is invested in over time. Those are the managers that build an immense amount of trust in that moment when actually their strategy is not as much in vogue, or for all the reasons we've talked about. And actually, when they do pick up the phone, or when the salesperson picks up the phone, you're much more likely to listen, right? Because they were honest when it wasn't a good buy, and so you're much more likely to listen to them when it is a good buy. So it's a really interesting approach, and one that I imagine has a lot of value. Can we move on to talking? Did you want to say anything on that?
I was going to say one thing. You see me like you saw me. Yeah, you can just sense it. Yeah. We did a crescendo on this, our weekly blog, this a while ago, and we said, what do we want? How do we want salespeople to talk to us?
I remember it.
Yeah. And the worst thing on this vein is the worst question. The question we hate is when people ring us up and go, "What are you looking at now?" And what are you looking at? What are you looking at? As if we'll go, "Oh, well, we're looking at European equities." And go, "Oh, well, I've got a European equity fund here." We always turn it around, and we say to the salesperson, or BDM or whatever, or fund manager, or whatever the person is, and then say, you tell me, what should we be looking at? Your fund managers better than I do. Who's the most excited, or who's feeling most beaten up but thinks that the prospects are really fantastic? So we love it when people get it. But again, I'm not going to be too critical, because I think we're fairly unusual in that respect. So I don't want to beat up salespeople for not. And anyway, we're only little old Hawksmoor. Can't expect them to be like, this is how Hawksmoor thinks. We all want to know how Hawksmoor thinks, and instantly know that that's not how we want people to speak to us.
Well, I definitely think there's a place for. Well, there's probably a place for both, isn't there? Because the truth is that sometimes there are people are going to be looking at something, right? Like there is going to be a live search which is useful for to know whether there's anything that could feed into that. But I also think there's a huge place. Like I think I was definitely known in the industry as being somebody that always wanted to know about first quartile performance over the long term and fourth quartile performance right now. And and that's something that even in AM Insights I've thought about kind of setting up an alert function for to flag when those strategies are there. But I don't know how widely it would be used. I hope perhaps if I build it, maybe it would be, that approach would be used a bit more. But I think it's it's probably something I imagine that's very much welcomed from salespeople.
Yeah, that sounds awesome actually. Let's talk about that after. What I do want to say is that the way we do things isn't the only way of doing things. I'm not saying that the way we do things is the right way, and I really got to be wary about coming across like that. There's lots of different ways to skin the investment cat, and I think just because I said at the beginning we don't do SAAs and TAs, it doesn't mean that that does and frequently does produce great results. Having a different way of monitoring fund managers is equally valid. I think that just the important thing, however you do it, is to do it really well and with a lot of care and attention, and you can still get great results through the market cycle. You'll just get result if you follow that road and do SANT. It'll be different types of results to the way we do things. And one of my big things, Lucy, one of my really big things is whenever speaking to clients, I'm like, we always point out the flaws in how we do things, so that if we've got a client who buys multi-asset funds, so they know when they're constructing their own client portfolios, we say to them, don't put everything with us. Not that they ever would, but don't put everything with us. Blend us with people who are doing things slightly differently. I think the thing that we always say that you should be checking on is, are their processes really good? Are they really good at that particular process?
It sounds like you're going to blend really well with the kind of the more of like the well-known kind of approaches that advisors can use. So yeah, it definitely was what I had in my mind. Cool. So let's think about the fund of fund portfolios themselves then. How many funds do you typically have in them? How do you think about weighting, given all the things we've talked about it? Is it equally weighted? Is it conviction weighted? Because some are going to have more cheapness than other. What do you think about kind of the margin of safety? How does that play in? Just interested to dig into that whole piece.
We run three funds, and they are across the risk spectrum. And typically speaking, the funds will have anywhere from between 35 to 50 holdings, which is quite a lot.
Yep.
The reason that's quite a lot is because we don't just do open-ended funds, we do closed-ended funds as well, listed closed-ended funds, and
something that we'll definitely be coming back to in a bit.
And investment trusts are tricky little beasts, and they can be in themselves not that liquid, and they can bring their own idiosyncratic high volatility. So we generally have more investment trusts for and the position size is smaller as a result. Right, let's try and answer your question. So how do we construct portfolios and weighting and things? So yeah, weighting. So I've just explained partly our weightings in investment trusts. They're smaller because they can be quite idiosyncratically volatile, and so we've got to manage that risk. But it is actually an art, far more than science. So often answer this question by saying, well, how would you do it any other way? Because if you get into the world of like mean variance optimization, I'm really skeptical of it, because if you start to try and get too quantitative about portfolio construction, is what you tend to find, it starts pushing you into exactly the wrong areas. And what we often say, so what I mean by that is lowest risk stuff.
What's done well and what's had low risk. Yeah.
Right. Exactly. And it's the same with actually correlations. So underneath, MVOs, you've got covariance matrices and all this kind of stuff, but correlations change as well, and they're not consistent through time, or certainly over the measurement period that's into your covariance matrix. So what we often talk about is like common sense mean variance optimization. So it's basically, that's our posh way of trying to sound clever, which is us looking forward.
Cross out the mean variance optimization and just say common sense, but you just add that on the end, and it sounds really smart.
Yeah, does it sound really smart? Well, it doesn't sound smart anymore, does it? Because I just said. But
interrupt you, carry on.
Yeah, I think it's sort of us trying to make a point that I think that there's an awful lot of art, but there's scientific methods behind it, which is that what you're trying to do is introduce things into the portfolio that have forward correlations that are varying, where the forward returns are outsized, not and justify the risk that you're taking. And then when you're doing position sizes, you're having to take a view implicitly on those sorts of things. So if, for example, something is available to us in a really liquid form, so a nice open-ended fund where the underlyings are really liquid and it's quite a big fund, so we don't have to own 20% of it to have a decent position. We can get our required position size and not own too much of it. If the asset is really cheap relative to its own history, and if it's really uncorrelated with everything else in the portfolio, we'll have quite a big position in that. We'll go to 8 or 9% in that, because it probably wouldn't go beyond 10, if I'm honest. We'll have those sorts of limits, but we've got concentration rules to think about as well because they're useless. But we could go those sorts of sizes, because if it possesses all those attributes, well, it makes sense. And it makes sense from this sort of common sense MBO analysis. It's like, if you knew this was how it's going to behave, then this is the thing, and it turned out to be correct, then this is the weighting you would have. And that's how we do it. We just go through each every time we're debating something and what it adds to the portfolio, we're having that conversation. So we have all these spreadsheets, and my colleagues are better at maintaining than me, analytical spreadsheets, which are all about forward-looking judgments. So we'll say every single thing that we own will assign characteristics to it. So how will it behave when interest rates are falling and interest rates are rising? How will it behave in this kind of environment, that kind of environment? And we'll have all these characteristics mapped out. So when we add it something, or when we look to adding to something, we'll see how those characteristics are impacted. And that's how we say, right, okay, well, that means that this is really, really cheap, but happens to be quite correlated to something else that we already own, and it's probably going to behave in the same way as something we already own, so that we'll have a smaller position size in that. So I'll pause there. Have I made sense so far?
Yeah, no, you have made sense. You have made sense. I guess the question I have is, if so, you can have between 35 and 50, which is a big range as well, right? 35 to 40, fine, but 35 to 50 is a decent size range. So is it the case that 35 just means you've got fewer investment trusts, because that tends to be the kind of okay, fine.
Yeah, it's mostly that. Exactly right, because our exposure to the closed-ended space, investment trust space, really varies dramatically through time, depending on the valuations that are prevailing, and they're amazing at the moment. They're so cheap, so we've got loads. So we're much more towards the higher number because of that. And that is the major swing factor for that. Yes, you're right.
And what about across asset class? Because we've been talking about equities, but to what extent do you have exposure to fixed income and alternatives in any of your portfolios?
Yeah, glad you asked that. So we only own assets. So or we only own portfolios that own assets. We don't buy. We used to try and do this a long time ago, and we very quickly realised we weren't very good at it, so we stopped doing it. We don't like owning strategies. So what we buy are equities, fixed income, all sorts of fixed income as well, and that you can access via open and closed-ended funds. And the alternatives exposure are alternative assets. Mm-hmm. So it'll be that again. Those will be because that's less liquid. That'll be accessed via investment trusts. So what are we not owning? Long-short funds, managed future strategies, absolute return stuff. Because what we want to know is have a really able to quantify a margin of safety. And how do you quantify a margin of safety in something that's like net exposure of zero? That when it falls in price, when something like that falls in price, that is a permanent loss of capital. It's not like it's an asset with an intrinsic value that's fallen in price and got cheaper, and we can take a view on that. So for that reason, we through time we really firmly we really have got a really strong idea of what a circle of competence is and what works. So for that reason, we only own stuff. The one exception to everything I just said there is gold bullion, because gold bullion is really hard to value. So what's the intrinsic value of gold bullion? It's a great question, and it's the one exception that we make, and we look at gold through a different prism, which is that our investors have sterling liabilities. Sterling is a fiat currency that's being debased and has been debased heavily, likely to be debased going forward. And gold in sterling terms is a fantastic store of value, and brings a fantastic attribute to the portfolio that otherwise we wouldn't have.
And you have that in your lower risk strategies rather than your highest risk, I would assume.
Yes, yeah. So gold bullion is a decent holding in our lowest risk strategy of Ambra. We do have exposure to the gold complex in the other two funds, but that's via gold equities.
Via minus. Okay. Yeah. Makes sense. Okay, interesting. So that did all make sense. You'll be happy to hear. So when it comes to your decision over you found a manager who's excited, right, about their asset class. They've articulated to you that there is an opportunity, or perhaps they haven't, but you're still interested to kind of dig under the skin maybe for future. How do you then, what attributes are you then looking for? You've got diversified portfolios, but not you're not owning the whole market. There's clearly thousands and tens of thousands of funds out there that you could potentially invest in. What are you looking for? What stands out for you? Maybe we could do equities and fixed income, if there are differences, that are things that just mean that you always know that's what we've got to see in order for us to get comfort. Or is it one of those we can buy anything?
Yeah, we try not to be too prescriptive. What I can do is paint a picture of like the perfect fund, and then move and then recognize that that's not going to exist, and then know we're always going to have to take compromise. So the perfect fund is usually, no, not usually. This is the perfect fund. Perfect manager, he or she is a large fund management organization and has had a fantastic performance and doing really, really well. Commercially,
is doing really well, or has done really well in the past. I guess I would
has done well in the past because this person has now left that organization. This is the perfect.
Yeah. Oh, right, fine. Okay, so now we're on to the next bit. Okay, got it.
Yeah. So this person has set up their own place that they have a very decent equity consideration in the firm, not necessarily ownership of the fund in the firm, and they've left their previous place because they were doing very well and commercially their fund became a success, and they maybe were beginning to have to sacrifice some of their investing principles and process to take more assets, or maybe it got too bureaucratic, or maybe they were too distracted by the fact that the firm was big and they had other responsibilities. So they just really wanted to focus on the thing that they really enjoyed and were good at. So they decided to go and set up shop somewhere else. They've got equity ownership in the firm, which means that they're never going to have any external pressures to change what they're doing, because they have either absolute control or negative control of the business. And they're clearly very, very happy, and they're right sized. And so what I mean by that is, when someone's happy, right? So what is so important, if you think about your prior life, Lucy, because I know we've chatted about this in the past, and when you're happy, you just perform better. And when there's fewer distractions, and when you're only working with people you like and respect, everything falls into place, and everything's in balance. And I often say that what really needs to happen is like the objectives of your loved ones and your family and your not so much friends, but the people in your sphere and that live with you and that depend on you, the objectives of them, yourself, your clients, and your firm should all align. And that's really difficult to achieve, and is usually only really completely achievable with high certainty is when you or the fund manager is in control of the destiny of the firm. So that's the perfect. So now that doesn't really exist that often, but we're just on the lookout. So if you think that's the perfect, then we're just saying, okay, right, what's out of balance here? Do we know, for example, this manager is, we get a sense for perhaps they're not being compensated correctly, or they're not aligned, or, we might get a sense, because you get a sense for these things after doing this for quite a long time, that firm doesn't compensate their managers fantastically well, or that's not, that firm expects, a sort of a franchise killing fund, and if it doesn't perform that role, they'll kill it off. Or we know that there's significant challenges in that firm in terms of management that is a massive distraction for this manager. All these kind of things, these are the things we're sort of on the lookout for. But I cannot underestimate the importance of getting a sense for how happy someone is in themselves. Are they seeing enough of their kids, if they've got kids, et cetera, et cetera. And I know this because I'm a manager too, and I know what makes me perform really, really well. Now, but it doesn't mean that I should impose my judgments on people. So there is an exception to this. So it's going back to the compromise thing. There's one, I don't want to name the firm because I don't want to sound like I'm judging them or making a judgment on their lives or anything like that. I'm not. But there's one firm where culturally in that firm, they work incredibly hard, like to an extent that I would be appalled if people in my team were working that hard. But I'm judging them through my sphere of reference. With this firm, because it's in a different country, a different culture, they love it. This is what they want to do. This is their aspiration. They're not unhappy. I don't want to impose my judgment of what happiness is on them. They're delighted to do it, and this is what makes them tick. So you can't be too prescriptive in this sort of thing. So when you're hearing that and you're thinking, your first reaction is, oh my God, everyone's going to be miserable there, absolutely miserable. That they're not. They have this particular firm. They just have almost zero employee turnover. They're so proud, and the performance is absolutely stunning as a result. So anyway, again, a long answer, but yeah, there you go.
Okay, there's a lot there. Let me try and think about which thread to pick up first. So I guess the the reality, so boutiques, right? That's you didn't use the word, but you effectively described a boutique setup. So of
Yeah.
your 35 to 50 funds in your funds, how many of those, I mean, either are or aren't, depending on which lens is easier to use, boutiques?
Yeah, really unfair question, Lucy, because you didn't let me prepare, and I don't have an answer for your
Or
tip.
just
But
like a gut feel proportion?
yeah, I know. Let's put the investment trust to one side because maybe they're all, I don't know, a lot of those are be boutiques. Don't have many of the big house investment trusts. On the open end side, I'd be disappointed if 60% were, if less than 60% were boutiques. Which, but then I'm just caveat that because really good fund managers are in the big houses.
Oh
And
yeah.
just because they're in the big house doesn't mean we're not going to consider them, and we do.
Yeah.
We're just always on the lookout for like the incentives, and are they about to move, or and are they risks? Is that portfolio risk from the manager leaving, all that kind of thing? And these boutique managers, if they're established, they were good managers before they were at the boutique. So, and we want to back those managers. And so I just want to heavily caveat it with that.
Yeah.
What was I going to say? We tend to find as well that it's really difficult actually to find these managers, and there are a couple of really good third parties, so third party organizations that represent and bring over managers from other from places that aren't the UK, and they're invaluable because some of our best managers aren't based in the UK, and they're not sort of part of the general milk round, what do you want to call it, sort of scene circuit that continue doing the rounds and are interviewed in Citywire and other publications. So it's really important that we hear about those, and that's just a really, really, really organic process. It's just you can't. It's really difficult to we don't go to Singapore and travel around Singapore trying to find all the managers that have got mandates that we can invest in. We don't do trips like that. Maybe one day we could do that. And the other thing I just wanted to say as well is that about the boutique thing, and why people might be thinking, why don't you have 100% boutiques? Explain. Well, it's bloody hard these days to start up, and it's probably, if I think about Hawksmoor, I think when Hawksmoor started, I joined about a year 18 months after it started. In 2010, so it started about 2008. There's no, well, let's exaggerate. The probability of getting our business off the ground now, and that's true of all fund management boutiques. And I think the burden of regulation at the moment is just heinous. Absolutely, it's so difficult. You have to have so much startup assets to justify your existence. So another thing is, as a moan, is that it's aspirational to be able to back boutiques and have everybody, but the reality is that the talented investors might not only be found in boutiques.
Absolutely, undoubtedly, yeah, that makes perfect sense. I have anecdotally seen an uptick in wealth managers actually branching out from some of the bigger firms and setting up on their own. So yeah, that's been quite an interesting trend I've observed in the last sort of 12 months or so, against, as you say, that kind of backdrop of regulation. So it'll be interesting to see kind of how that progresses. Okay, fantastic. I wanted to pick up on something that you kind of referred to earlier that made me think. So your approach is one of, as you say, diversification and margin of safety and those kind of common sense correlations to build a portfolio that's going to meet the objectives. What I'm interested in is, because you're always looking for that margin of safety, and because obviously markets change, what would you say, and again, typical rather than a specific percentage, but what is your kind of typical turnover? Where, how much are you buying new names, on a sort of per year basis, but also how much are you then kind of adjusting position sizes? So two questions on that one.
Yeah, quite a lot actually. Yeah, quite a lot. And our turnover is actually a function of price movements, obviously, relative to that.
I had assumed so.
Yeah. So if valuations are changing, then we'll change our exposure accordingly. And because of our investment trust exposure, our turnover, I think, relative to our peers is probably quite a lot higher, because in investment trusts, their NAVs can be relatively stable, but their share prices aren't always. You can extract a lot of idiosyncratic returns from investment trusts by just taking advantage of the discount volatility. and that means a bit of turnover. So our turnover can be quite high. It can be up around 60, even 70%, depending on what's going on in any one year. But you have a year that's really volatile, then yeah, if you have like the COVID period, goodness me, it was really volatile. It was a lot of turnover just because things V-shaped, and we were just having to react because prices were changing so quickly and intrinsic value wasn't. So we were adjusting the portfolios a lot.
So in that year, maybe even, I don't know, double perhaps what the average year might have been.
We have done the analysis, yeah, but it was very, very high. I don't want to put a number on it, but I wouldn't have been surprised if it was up at 70, 80% through that year.
Interesting.
Is that high? Is that high?
Yeah. Well, I thought that would have been even higher actually, because if your average is 60 to 70, I would have thought it would have been, well.
Yeah, it might be even high. It might even have been even higher. We did do the analysis, just don't have it to hand. But yeah, and it would have been even higher in the higher risk portfolios as well. But yeah, I just remember we just this huge switch into, between credit, within fixed income, between credit and non-credit, and then between credit and infrastructure, and right into the investment trust stuff. So yeah, it was really good. But yeah, we was one of the reasons I like to think we're quite heavily resourced. We've got 4 fund managers on just 3 portfolios, and that enables us to react really quickly. And when you're trading investment trusts, they're really high maintenance, so you have to have that resource there.
Yeah. So I want to come on to investment trusts, as I kind of alluded to earlier. But before we do, I just want to spend one moment talking about passive, because like I referred to beginning, we had that fantastic debate where you, me, and Simon Evan Cook, who was the first guest on the Fund Selectors podcast, we argued for active management. And I think I'm right in saying you don't have any passive in your portfolios, but I just want to make sure that I've remembered that correctly.
We actually have a teeny weeny bit. Okay. Does gold bullion count? Not really. It's okay.
Not in the way I would think about it. So aside from that, have you got any?
Some government bonds exposure, a small, but that's it. We're not anti-passive.
No. Well, as we discussed in that session, none of us was actually anti-passive, but we were anti the suggestion, actually, kind of to your point about value and growth earlier, right? It's actually not that people use it because it's kind of easy to define, and in the same kind of active and passive. I think my big conclusion from that was actually there isn't really any point in arguing active or passive, because every decision is an allocation. What index, what are the rules behind that index, what market you're going to invest in, all of these things are decisions. So for me, it was much grayer than I think maybe everyone thought going in.
Yeah, exactly, Lucy. I mean, we just violently agree on this. It's not going to be that interesting for people to listen, but watch. But the other thing I think about the active, which is just is completely missed, is that no proponents of active say that they've got. We know that active in aggregate. We know that if you just had a dartboard, you're probably going to not do that well. You're not going to have a higher hit rate than 50 in finding an active manager of the universe. But it's like anything in life. There's 2 things I want to say. That anything in life, if you put work in and you're diligent and you work hard, then you will get returns. And in our world, where we're trying to identify active managers that are going to perform well, then the same thing applies. If you just work really, really hard and you're really diligent and you've got a really strong process and you stick to it, then yes, the probability of success goes higher the harder you work and the more diligent you are. So it really annoys me. The thing that annoys me most about this active versus passive debate is it is so reductive. People just think it's like active as a splodge and you just allocate to active. You don't. But the other flip side of that is that I've got absolutely no problem that if somebody off the street says to me, Ben, I want to start investing, should I pick active funds or passive funds? I say, if you don't have the time to really do the work here and really commit to this, you are better off. And you're just talking about really liquid parts of investable assets. Just stick to passive, because it takes a lot of effort and there is risk if you pick the wrong active fund and then it underperforms for a period of time. And if you don't know the reasons why and it doesn't fit in with your portfolio, then that's a real risk. So one more thing as well, because this really speaks about us. What is good performance, right? If the active fund has underperformed, it's like what I said at the beginning. If it's underperformed so let's say take a US equity fund, underperform US equities. Well, it depends on your objective, right? If your objective is pick a fund that outperforms US equities, okay, fine, we'll view it through that lens. If your objective is, I want to find a portfolio with these characteristics that contributes to my portfolio, my overall portfolio, and improves the risk return characteristics of that portfolio, and it still underperforms, and good doesn't necessarily mean that it outperforms US equities. So that's the other thing. It's just the debate you see, and so much about the debate that we see on in financial media and on LinkedIn and the rest of it. It's just so reductive and boring. Misses all of these points.
Yeah, the word reductive is literally bang on in my view. Yeah, completely agree. Okay, I want to move on to investment trusts, because for those that don't know Ben has been highly involved in a significant amount of work that's gone into making the rules around the way in which investment trusts have to report their costs more reflective of reality. Ben, do you want to just give us a sense of, what in a because I know you've put an insane amount of work in over a very long period of time, but in a relatively summarized version, do you want to just give everyone a sense of what it is, the journey that you've been on, and what you've been trying to get through or to battle for?
Yeah, sure. It's not just me. There's probably about a dozen of us that are really committed. So it's been fantastic, and the most public proponents of the work that we're doing, you'll know Baroness Bowles and Baroness Ottman, who are just amazing people. But we've been working with those, and increasingly in the recent past and future, the AIC. But yeah, in short, the rules have been requiring the disclosure of investment trust expenses as if they were the same as open-ended costs. And we'll all know that with open-ended funds, they have OCFs. And those, what does that number mean? It means that this is, if your OCF is 1%, that 1% will come off the value of your investment every single year, regardless of the performance of the portfolio. Investment trusts are completely different instruments. Investment trusts obviously have their net asset value of the portfolio, and then they have a share price, so they're listed. And the two things do deviate, and they're not the same. And to the extent that investment companies have a figure that's similar to open-ended funds, and let's call it what was previously called ongoing costs, those are deducted from the NAV, the portfolio, not the share price. And being hitherto, and until the recent forbearance from the FCA that's now gone into law, although we've now got the CCI consultation, but let's get onto that in a second.
Yeah.
Hitherto, so it would be investment trusts or owners' investment trusts were being forced to report and aggregate those ongoing costs, which I think are correctly described as corporate expenses, as if they were being deducted from the value of your investment. And I think, as any investment analyst knows, when you're analysing an investment, if there's cash flows that are going to be deducted, then you discount those cash flows into your assessment of value. So with an investment trust, one of the factors that pushes investment trusts to discounts naturally is the fact that you have got a net asset value in a management contract. And if the management contract and other costs, but let's just focus on the management contract and AMC, is say a 1% AMC that's been deducted from the portfolio NAV for 5 years, well, then the share price will discount that management contract, and it pushes it to a discount naturally. So that's why our campaign slogan was disclose, don't double count. And what we meant is that these expenses should be disclosed, and investors should know what they are, but being forced to count them as if they were the same as an open-ended OCF is double counting them, because it's already in the share price and nothing is being deducted from that share price anyway. So we fought years and years and years to get that forbearance, and now we have a new battleground, which is that investment trusts, the Treasury has declared that investment trusts should be part of the CCI regime.
Just hold up a second. So just to cover that part off. So basically, after all of that battling, and you got the Baronesses involved, and you took that. They took that to the House of Lords, and they did. They spoke a lot. Well, certainly Baroness. They both did, didn't they? And they both separately spoke, and the FCA basically issued this forbearance, which meant that they were saying, okay, we recognise that this is a problem. We agree, I think, broadly with what you're kind of outlining, perhaps in some of the detail, to be confirmed. And so they actually, if I remember rightly, issued immediate guidance to suggest that those costs could be didn't have to be disclosed in the way that they had, not disclosed, that's the wrong word, counted in the way that they had been previously. And so immediately we did see some changes to certain trusts and certain fund of funds changing the way that they'd calculated the fees. I just wanted to check that I sort of summarised that correctly.
Yeah, good summary. And the way that it really impacted, say, us, is that we are multi-asset fund investors, which are fund of funds, open-ended and close-ended. And it meant that the way that the OCF of our own funds was artificially inflated. And because we use investment trusts really quite extensively, they can be anywhere between 30 and 60% of our portfolio, depending on prevailing valuations. If you've got 60% of your portfolio in these things, and it could be an investment trust that's a specialist in alternative assets where running costs of that portfolio can be quite high, then it was making our funds look ridiculously expensive.
And sorry, I'll just add one additional comment there. So in addition to the management fee and the additional expenses which you would have in a typical open-ended fund, in that calculation there were lots of additional charges, weren't there, like things like interest expenses, which would never be included on an equivalent open-ended OCF calculation.
Yeah, exactly, and other administrative running costs as well, and that's why, by the way, led actually to give him his credit, David Appleton at Brooks. He formulated something called the statement of operating expenses that he and I then worked on propagating, and it's great to see. If anyone's interested in this, have a look at the Aberdeen stable of investment trusts, and Murray International became the first trust to issue a statement of operating expenses, which is basically a list of all of the expenses that are deducted annually from the net asset value, so an investor can look at appropriate disclosure, but it's surfaced in the right way. It's not surfaced as an ongoing cost figure, which is deducted from the share price. It's not deducted from the NAV. And then what that does is it's beautiful because it enables comparison of an investment trust to an open-ended fund. So say if you've got a UK equity investment trust and you've got a UK equity open-ended fund, you can compare those expenses as a percentage of NAV for the investment trust to the open-ended fund, as long as you're also considering other factors like the discount, for example. So if they both got an OCF of 1, but the investment trust, and they're both doing exactly the same thing, but the investment trust is a 10% discount, well, guess what's better value?
And remind me what happened with the platforms with the trust that did update in that way.
Yeah, talk about unintended consequences. What do you mean, the retail platforms? Yeah, wow, this was really left field. So having really hard won this forbearance, and this forbearance applied to the investment trusts themselves, but also to the distribution chain. So just quickly, it means that that forbearance was so strong because even if the investment trusts were continuing to disclose in the old way, to say, this is our ongoing cost, the forbearance said that the fund manager, can say, actually, that's wrong. It doesn't have an ongoing cost. It's not going to contribute to my OCF. But what happened with the platforms is that the retail platform said, any investment trust that takes advantage of this forbearance and says that they have zero ongoing costs, we're not going to allow our customers access to these trusts. And the reason for them doing so was under, in my view, in my very personal view, was spurious, related to consumer duty, for example, saying that we believe these things do have costs and they need to be surfaced to consumers before we can offer them for sale. Now, everybody keeps forgetting these are listed instruments that have to obey UK listing rules and issue interim and final reports and accounts. It's all there. It's always all been there. And incidentally, by the by, for listed equities and fairly risky, equities, and even some equities that professional investors don't invest in, consumers are free to buy those without any sort of disclosure other than the reports and accounts. So why this odd standard was being applied to these investment trusts, I don't know, as well as the sort of fundamental misunderstanding that it is that is just simply misleading to be forcing an investment trust to disclose that something is being deducted from the value of the investment, which is the share price. It's madness. So we've got this, it's really poor. And so any investment trust at the moment that takes advantage of that forbearance, and there are only about 6, I believe, maybe there are 9 now that are actually doing this, they've been deplatformed. Some of these you can't now buy on these platforms because they're I think, correctly disclosing the fact they don't have any ongoing costs.
So CCI?
CCI. So the CCI is a consumer composite investment regime. It's the broad piece of regulation that replaces PRIPS. So we left the EU, and so Treasury and FCA are taking advantage of the fact they left the EU, and the CCI is a very broad, it's all consumer composite investments, and it's basically a set of regulations that says you are a CCI, and if you are a CCI, these are the rules that you've got to obey. And rather disappointingly, investment trusts have been caught up in the CCI. Now, we don't think that's correct. We don't think that investment trusts have any of the attributes that mean it should be a CCI, the main one being that's listed. And as soon as something's listed, you automatically get a huge number of protections. And what we don't want to see is a double up of regulations. But the consultation on the CCI regime started. It started just before Christmas and finishes on March the 20th. And we will be fully, when I say we, I mean the campaign group and associated firms will be fully participating in that. Our first thought is that they just shouldn't be part of the CCI. I still think we should continue to argue for that. And I hope that those arguments will be listened to by both the Treasury and the FCA. And I think that should just be the correct treatment. If they are going to be in the CCI, and I really hope they don't, because that would be definitely in the world of second best, it is absolutely imperative that we don't reverse, we don't sort of make the same mistakes that were previously, because in the consultation, if you read the consultation paper and the way it describes how they think investment trusts should be treated under the CCI, there's a real risk that they will require wrongful disclosure again. And there's one bit of it that's infuriating. They say that if you're a passive tracker, the suggestion is in the consultation, if you read it like this, if you're a passive tracker, let's say a FTSE 250 tracker, you don't have to aggregate the costs of investment trusts. And 37% of the FTSE 250 are investment trusts, but everybody else should.
Yeah,
anyway.
that is a strange unbalanced situation.
Yeah, it's caused such damage, Lucy. You know, you're chair and being a nerd on trusts. You'll know, and you've been a fund of fund. You know all this stuff. In the post-consumer duty world, it is commercial suicide to have a high OCF. And if you invest in these things called investment trusts, where you'll wrongfully have to include their expenses as ongoing costs, well, guess what happens? No one owns them anymore. And that's on top of the pressures that were already there from the consolidation of the wealth management industry and people getting bigger and bigger, and fewer investment trusts are liquid enough to go on their buy list. So the sector is in really quite catastrophic trouble. And the latest evidence of that is obviously we've got activists coming into the sector that are taking advantage of this market distortion.
Yeah, a whole nother
podcast.
Yeah, to dig into that. Yeah. For now, I'm going to draw this section to a close. It's been fascinating, and yeah, we definitely could dive into podcast 2 almost immediately. Have you got time? But yeah, for now, let's go to the questions that we ask at the end of every I ask at the end of every podcast. So the first question for you, Ben, is what book has had the biggest impact on the way that you think about things?
Right. Disappointing answer, in that these days I don't read investment books. I read other stuff because I get enough of it in my day job, and I think it's really important to give your brain a break. Back in the day, there were a couple of books and then academic work that really influenced me. So Kahneman, Tversky, prospect theory, that was a big thing for me at university, behavioral economics and the way that investors come to decisions. It won't be too surprised to hear the way I've been thinking, the way I've been talking, that Seth Klarman stuff on margin of safety, that was a big one. And then another one I always remember is Joel Greenblatt's little book that beats the market. But the main thing for me about all of this stuff, Lucy, is you can't solve investment. You can't do it. So there's a real risk, I think, of just reading and trying to find all you're going to get is we're going to realize that the best investors, they get really good results by just being disciplined and sticking to that one thing and doing it really well. And you can have the value investors brilliant and the growth investors brilliant. They just perform at different times in a market cycle. And then if you give them both long enough, they're both going to produce different results. It'll just be at different times. And I think that's the real art of a multi-asset investor, is blending all these different types of funds together to create that really robust overall portfolio through the market cycle. So anyway, yeah, there's not this one book where I'm that's the one. It was just reading lots of stuff and then realizing that all these guys are really good, but they all do it differently.
Yeah, no, definitely. Hugely in agreement with that. Okay, so the next question comes from our last guest, which was Shakista from RBC Brewin Dolphin. And her question actually, interestingly, partly relates to one of the books that you mentioned. So she asked, what behavioural bias have you realised that you have or had, and what did you do to work on it, or what will you do to work on it?
Yes, that's just an amazing question.
It is, isn't it? I knew it was going to be a really fascinating one to hear the answer for.
So I think, maybe you should tell me as well, Lucy, what it is, and then I need to go work
for an hour of chatting.
yeah. I'll go work it. I reckon it's forming judgments too quickly, and I don't want to say the word judgmental because that makes me sound like not that nice a person. Maybe I'm too judgmental, but what I mean is I have a tendency to form judgments very, very quickly. So in this context, give a fund manager a chance. So if the first half an hour of the meeting's rubbish and they haven't answered the questions, that doesn't necessarily mean that fund manager isn't going to be the one for you. It may just be that they're nervous, or this isn't, they're fund managers. They're not presenters. They're not, they might not have done presenting training, or they might not enjoy it particularly. You don't need them. What you want for a fund manager is then to be really good at what they do in terms of the investing. And I think through time is that the way that weakness manifested itself was either missing out on good managers, but probably more frequently falling in love with other managers because they just spoke the language that you wanted to hear. And you just find yourself doing two things. One is that you buy them when you shouldn't have, and secondly is you forgive them for longer than you should do. So I think through time, just always double checking. And then one of the sort of control factors is having four people with a flat structure who know that's what you're like, and can say, no, Ben, you're doing that thing again.
Love that. Yeah, definitely using each other, actually. So you kind of know that that's your bias. You can work on that, but actually you can have sort of somebody else. That makes a lot of sense. All right. So what question do you want me to pose to our next guest, who you don't know who it is yet, but what would you like me to ask?
I think it would be, what is the one thing about the firm that you're at, or the process that you're operating in, that you would like to change that you can't at the moment, whatever reason? Does that make sense?
It's a really interesting one, because it might be quite hard for the person to answer what the reason is.
Yeah, like my boss.
Yeah. But yeah, I'm definitely going to ask it and watch as the cogs turn. Brilliant, Ben. Thank you. It's been an absolute pleasure to have you on. Really fascinating conversation. In many different directions. But yeah, really, really great to have you, and see you soon.
Yeah, thanks, Lucy. Absolute pleasure. Thanks for having me on.
Bye.
Bye.